Welcome to the Rogue Trading Communities video, and this video is about multiple time frame analysis concept. And this series, the moment I say series is because this is only a part 1 of this concept. There will be a part 2 and there will be a separate playlist for this entire concept. So make sure you watch the entire series. Okay. Let me tell you something about multiple time frame analysis is because this is something that every trader has to learn no matter who you are. Okay? Because if you have been inspired by any good traders out there who's making consistent returns out of the market, it could be in internet, it could be some famous traders out there, every single one of us do multiple time frame analysis. Without this, it is definitely a suicide if you talk about it. So you have to, it doesn't matter even if you're a price action trader or a VSA trader or any type of technical analyst, you have to use multiple time frame analysis in your trading system. Okay, so let's get started. But before that, let's understand this one thing. Always when I'm teaching you a concept, it has to solve some sort of problems, right? So as a trader, we have problems like, there might be someone out there who might be having a problem in terms of entries. They are not finding good entries in the market. They're always having a losses. So what kind of problems this multiple time frame analysis can actually solve, right? That is something that first we will think about it. First thing, usually I get this questions like, can we identify the overall trend of the markets using multiple time frame analysis? The answer is yes, you can do it. Can we identify the high probability entries? Because as a traders, that's what we needed, right? Definitely as a traders, you have to find high probability entries, and then based on that, you can take multiple risk out there. But at the initial phases, you should always focus on high probability entries. Okay, because deep down that the probability of this trade hitting my target is higher. Those are the high probability entries. And yes, definitely. And can we trade any markets using this method? Obviously, because in this video, I'm going to use candlesticks, or in simple, I'm going to teach you price action. Actually, okay, price action in the sense, not the typical price action that's already available right there. This will be a little bit different because I've included other types of technical analysis and I made like one concept so that you can understand it in a very simpler manner. Okay, I've simplified this concept. So obviously you can trade any markets using this method because we are going to use price and volume, which is available in any market out there. Just a simple trading view is way more enough. Okay. Now, is it only for volume spread analysis traders? Well, you might be asking because we have been making volume spread analysis content, and you might be thinking, is it only for volume spread analysis traders? The answer is no, this is universal. Okay. Why it is universal? You will know at the end of a concept. Okay. Once you complete this concept, then you're going to learn about it. Right? Then, I'm a novice trader, so is it useful for me? Well, obviously, I'm making content for the beginners and intermediate traders out there because professional traders are already making consistent returns out of the markets. They don't need this concept. I'm making it for you guys. That is the reason I've simplified it and I'm giving you in the best manner as possible. Okay, so definitely it is even for you guys. Okay, so let's get started. First thing, let's understand the table of content that's available in this entire concept. Okay, so first thing we're going to learn about the multiple time frame analysis theory, right? And then we're going to learn about market structure, a little bit of a basics of Elliot waves I'll be including in it. So then the third thing we're going to talk about right entries and exits, because as a traders, that is what we have to master, right? If you're taking right entries and exits, obviously you'll be a consistent trader. Money will automatically follow you, right? That's simple. Then we're going to talk about different phases of the market. Well, here is something that usually a lot of people make the mistakes. They don't use multiple time frame analysis when they are understanding different phases of the market. That is where we'll be actually taking a trade. So we'll talk about that. And finally, as you know, this is how I teach. I show you practical examples so that you can understand the concept in depth, right? That is what we will be talking about. But in the part 1, we will be talking about these 3 parts. Okay, make sure we'll be talking about this 3 part because you have to master the basics, then you have to get into the concepts. Okay, but in the part 1, at the end of the video, you will have a clear structure of the market in your mind. The moment you see a chart from hereby onwards, after completing this one video, you will exactly know whether you can trade in this market or not. I guarantee you that. That is the level of concept I'm going to teach you today. Okay, let's get started. Now, let's talk about the theory part first. Multiple time frame analysis is a process of viewing the same trading instrument under different time frames. Whereas this method can help traders to determine the overall trend of the market so that the trader can time the entries and exits of their trades. Also, it helps them to stay at the right side of the market to increase their probability of winning trades. In simple, we will be doing an analysis. We will determine the trend using multiple time frame analysis from a higher time frame to lower time frame. And once we enter a trade, I've included both entries and exits right here. Entries and exits, because entry is something you'll get it from a higher time frame to lower time frame when you determine a trend. But what about exits? That has to be exited in the live markets, right? So we will use multiple time frame analysis on live markets also. Constantly we will check different time frames to understand what kind of structure is happening in the market, what kind of activity is happening in the market in different time frames. That is what the MTF, the multi-time frame analysis, is all about. Okay. Now let's get into the practical part so that you can understand it in depth, because theory is important. That is the reason I've included the theoretical part. Okay. Now, before getting into the multiple time frame analysis concept, you have to understand market structure, because when I started the VSA content, I'm going to take 2 minutes of it before starting this topic. When I started the VSA content, I thought there are already more price action content that's already available in internet. So people already know price action. So they just lack to understand liquidity in the markets. So I have introduced volume spread analysis, and I thought, okay, let me give you the volume spread analysis content so that you can understand volume right now. And based on that, you can include both price action, volume spread analysis, and make better decisions in terms of taking entries and exits. But the problem is, once I started realizing, once I had a conversation with a lot of subscribers and members out there, I realized that you guys doesn't even understand what is the basic market structure. That is the reason I've included this. Within this one video, I've included the basic market structure. Okay. After completing this, then apply volume spread analysis. Okay. Let's get started. Now, what is the basics of market structure? As you know, that price usually creates an uptrend or a downtrend, a up move or a down move, that you can call it in price action, right? When it creates a up move or a down move, how do you recognize this up move and down move? By a simple terminologies like higher highs and higher lows, right? When we are determining an higher highs and higher lows, you can know, since market is creating a higher highs multiple times, then it is a clear sign that market is in an uptrend, right? And same thing goes on right here. I have an example for you. I've drawn a simple higher highs and higher lows right here, right? You can clearly identify what is higher high and higher low just by looking at this chart. Okay. And if you can talk about downtrend, it's also the same thing. We will be considering that as a lower highs and lower lows. Okay. And see here, I have drawn a simple lower highs and lower lows diagram right here. So that you can understand, because I'm going to give you examples also so that you can understand in the markets. I'm not going to give you some theory. I'm going to give you some practical examples also. Okay. Now, the basic market structure, let's go over the part 2 of the basic market structure. Now, if you can recognize higher highs and higher lows in the market, you can easily recognize the concept of impulse and correctives. So what is this impulse and correctives? Impulse and correctives is nothing but, in an uptrend, when market creates a up move, that is your impulse actually. Okay. And when market creates a counter move, which is a down move in an uptrend, that is your corrective actually. Or in simple, when market creates a momentum from a higher low to higher high, that will be considered as an impulse. When market creates a momentum from a higher high to higher low, that will be considered as a corrective. In an uptrend I'm talking about, only on an uptrend. And same thing goes for a downtrend also, right? When market creates a momentum from a lower high to lower low, that will be considered as an impulse. When market creates a counter trend momentum, which is an up move in a downtrend, from a lower low to lower high, that will be considered as correctives, right? These are the very basics. Hope you understood this, right? Now let's talk about types of correctives, right? So we have an idea about what is impulse and correctives in an uptrend or a downtrend, right? So usually we don't actually, we are just capturing the impulse, which is great. But when it comes to entries, correctives are very important for us. Okay, we have to understand about correctives. So usually to recognize different types of correctives, there are usually two types of correctives that I've included in this concept. The first type is also known as angular corrective. So what is this angular corrective? So usually when market creates a momentum from a higher high to higher low in a counter move, in a down move, in an uptrend, and that is considered as an angular corrective. And what is RH and RL right here that is mentioned in this chart? So usually when market creates a momentum from higher high to higher low, it might create small swings right here, right? So until and unless the higher high has not been broken, if it creates a momentum right here, if it creates a momentum on this scale, that will be considered as random highs and random lows. Okay, just understand it, the very basics. So this is the angular corrective, and the second type I would like to add right here is the horizontal corrective. Simple, as you know, when market creates a momentum from higher high to higher low, but it stays in a range actually, right? The random highs and random lows creates some sort of like a sideways momentum. Even it creates a swings, it creates in a horizontal swing actually. That is called horizontal corrective, right? Hope you understood this part. Now let's get on to some practical examples. Okay. Now look at this chart. So this is one of the charts previously that I have showed you, right? So there is a simple higher highs and higher lows that we have recognized right here. Once we recognize higher highs and higher lows, we can recognize impulse and correctives, right? So now you can see right here, when market creates a momentum from a higher low to higher high, that is your impulse. But here you can think about this particular phase was a corrective. This entire phase was corrective because it was creating a momentum in one range. And that is the reason I have considered this as a corrective, right? The maximum levels that market reached was up to this point before creating a low moment, before breaking the low, like the maximum level that market reached up to this point. So that is the reason I have considered this as a higher high and this as a higher low. But this entire phase was a horizontal corrective. And market went up again from a higher low to higher high. Again, you got one angular corrective right here, created a down move in an uptrend, right? Clearly. And now again from a higher low to higher high, you got like one good impulse, again an angular corrective, right? Again a correction, again an impulse from higher low to higher high, again a horizontal corrective, again impulse and horizontal corrective. This is what impulse and correctives are all about in a very simpler manner. If you can understand this, you can easily find impulse and correctives in any time frames. Okay? Hope you all understood this. Now, let's get on to the next part. So what is the next part right here? The next part, the part 3 of the basics of market structure. This is the final part I would like to add right here in terms of basics, is the trend alignment. So what is this trend alignment? So as you know that if one time frame has impulse and correctives, so the lower time frames have multiple impulse and multiple correctives, right? If you want to understand, I have given you this one line diagram, and this is, let's assume this is a 1 hour time frame and market is creating a uptrend right here. Market is creating a up move, and within this up move, the blue line is your impulse and the red lines are your correctives actually. Okay. Now I have labeled it as 1, 2, 3, 4, 5 so that you can understand different points right here. Okay. So you can consider this as a 0, 1, 2, 3, 4, 5. Okay. Now, if 1 hour has 3 impulses and 2 correctives, how much impulse and correctives do you think a smaller time frames like 30 minutes, 15 minutes, 10 minutes or 5 minutes have it? Let's check it out. Now I have one more chart right here. Simple. If the 1 hour, the entire move right here has 3 impulses right here. Within that one impulse, you have multiple swings right here. Even that multiple swings, you can identify impulse and correctives, right? This is what trend is all about. Okay. Trend can be found in any markets. Don't worry about the correctives part. Don't worry about this part. We will not trade this. We don't actually, the thing is, we will actually take a trades at the end of a corrective or within this corrective. This is where we will be taking a trade. We will not take trades at these points. So don't worry about these part. Okay. But you have to recognize it. The concept of this basics Elliot waves is that I wanted you to understand that if you have one candle of 1 hour time frame, right? Within that one candle, you can get multiple swings in a lower time frame like 5 minutes. So if you wanted to understand, let me give you some example right now. Okay. Now, as you can see right here, you have a 1 hour time frame. This is Nestle India 1 hour time frame chart. And we have recognized the impulse and correctives just by recognizing the lower highs and lower lows. Simple. And now we will focus on this part right here. Okay, this part from this lower high to lower low. Now recognize this part. As you can see right here, market is creating a down move. But if you can switch to a smaller time frame, how many lower highs and lower lows you are getting it right here? Right? Simple. For lower highs, lower lows, it's getting it. So how many impulse you got it? Right? From here, if you can talk about, right? You got 4 impulses, right? You got one angular corrective, market went down. Again, kind of like an angular corrective, a smaller horizontal corrective. You can trade all these things actually. I'll teach you about it, but you have to understand. You got a horizontal corrective and market went down right here. Hope you understand this. Great. Now let me show you some more examples in the trading view terminal. Now we have this Bharti Airtel Limited. So as you can see right here, this is the monthly time frame, right? So we will do some analysis right here. First, we will determine a trend, right? From a higher time frame to lower time frame. Now you can see right here, market is creating an up move, clearly higher high momentum. So we can consider monthly is an uptrend, right? Weekly. If you talk about weekly, the overall weekly is also in an uptrend. Perfect, right? Weekly is creating a move. But if you can talk about swings, monthly just had this one swing, right? Just had this one swing normally. You have like one smaller corrective. If you want to understand that, you could have gone to weekly. You could have clearly understood this impulse, corrective, impulse, right? Simple. If you can go to daily, right? I'm talking about only this impulse right here. Daily. How many impulse and correctives you might be having right here, right? You got an impulse, corrective, impulse, corrective, right? Impulse, again, market came down, again a corrective, impulse, market started creating a higher high, corrective, impulse. So technically you got multiple impulses and correctives on a lower time frame, right? If you can go to 1 hour time frame, how many impulses and correctives you might get it? Unlimited. Okay. I'll talk about entries in just few minutes, but just stick with me, okay? So you get multiple impulses and correctives right here. Great. I hope you understand impulse and correctives in different time frames, right? So this is what you have to analyze the impulses and correctives the right way, okay? Now, let's talk about the most important part that we will be waiting for. The thumb rule for high probability entries. So this is what we will be looking at. So as a traders, I'm giving you an introduction to it because we will be talking about this in the part 2. But you have to understand where you can actually take a trade in a market, right? So all you have to understand is that every single time, no matter what, you have to take the trades at the end of a corrective and a beginning of an impulse for a high probability trades. Okay? Do not take the trades at the correctives. You have to just capture those impulses. If you want to capture those impulses with the trend, then you have to take a trade at the end of a corrective or within this impulse. That's it. Okay. So in this chart, in one simple chart, how many opportunities you got right here? You got a horizontal corrective. You got like 2 opportunities right here. You got third opportunity. You had a breakout. Again 4. Again 5. You got 5 opportunities right here. If you ask me. 5 opportunities. How to take the trades, I'll teach you. Don't worry about it. I'll teach you exactly, because if you already know volume spread analysis, you have already know Wyckoff schematics, you know how to trade the horizontal correctives right now. If you know supply and demand divergence approach, you know exactly when you can use no supply and no demands in the market, and based on that you can take an entry, right? I hope you got an idea right now. So this is where we will be taking a trade. Always we will be taking a trade at the end of a corrective and a beginning of an impulse for a high probability entries, right? So technically, if I'm gonna take an example right here, we will be taking a trade at this point, right? And in a smaller time frame, we can take trades at this points, right? We get multiple opportunities. So either you can play positional, either you can play intraday. That completely depends upon you, right? So this is the end of part 1. Okay, So this is very important. You have to complete it. If you didn't understand it, please watch the video again, because whatever we have covered right here, we will be including that in the actual multiple time frame analysis concept in the part 2, so that you can understand. If you can't understand part 2, it means that you haven't watched the part 1 of the video. Okay. So that's it for this video. See you on part 2. Goodbye.